The real interest rate versus gold. How does this relationship affect gold prices? Well, there is the standard story, and then there is the present one. To know the whole story, right now, see the link in the video description to access the full article. In this video, we will discuss the commonly understood correlation between gold prices and real interest rates. But more importantly, we will discuss how this long-held correlation may now be broken due to the present U.S. national debt situation. So be sure to watch to the very end and learn about this new economic paradigm. Generally, there is an inverse relationship between real interest rates and gold's value. From analyzing data from past decades, it is quite evident that gold prices are inversely correlated with real interest rates. Simply put, when the interest rates fall, gold's appeal increases, driving up the price. When interest rates rise, the allure of holding gold, which doesn't offer an interest yield, diminishes. Although we will discuss a gold investment option that offers a real yield regardless of the Fed interest rate later in this video. It's important to note that while there's a general inverse relationship between the interest rates and gold prices, it's not a hard and fast rule. Market sentiment, inflation expectations, geopolitical tensions, among other factors can influence gold prices. When interest rates start to climb, you'll likely notice a corresponding decrease in gold prices due to investors shifting focus towards assets with higher annual yields. Some of the factors are the strengthening of the US dollar. Gold is priced in dollars, so a stronger dollar makes gold more expensive to foreign investors, reducing its demand. However, presently we have seen an exception to this trend due to the mass amounts of foreign central banks buying record amounts of gold in the past 10 years. This has also coincided with the reduction of holding U.S. bonds by these same central banks. The perception of economic stability. When interest rates rise, it often signals a robust economy, which reduces gold's appeal as a safe haven asset. The increased opportunity cost of holding gold. Higher interest rates often mean that you are missing out on higher returns from investments such as bonds. To address this specific opportunity cost of holding gold, Monetary Metals is a gold investment company that offers a yield on gold paid in gold through the company's fixed income investment products. The company's gold lease programs offer investors an opportunity to take advantage of all the upside of holding gold, as well as earn a real yield competitive with real interest rates set by the Federal Reserve. To learn more about Monetary Metals' yield-bearing gold investment products, see the link in the video description to be taken to their official site. One of the most notable historic exceptions to this inverse correlation was the stagflation era of the 1970s, where the Federal Reserve hiked interest rates at an extremely aggressive pace. From 1971 to 1980, gold's value increased approximately 2,200% over this 9-year period. So again, this inverse correlation between gold prices and real interest rates is not a hard and fast rule. In contrast to rising interest rates, a drop in these rates often sets the stage for an upswing in gold prices. Why is that? Well, when the interest rates fall, the cost of holding non-yield generating assets like gold also decreases. At the same time, lower rates can also lead to inflation, which erodes the value of paper currency and also, in effect, drives up the gold price. Historical data supports this correlation. Take, for example, the period between 2000 and 2001. The Federal Reserve cut interest rates from 6.5% to 1.75%. Wow, that's a lot. And during that time, gold prices rose approximately 13%. In a similar fashion, during the 2008 financial crisis, when rates were slashed to near zero, gold prices doubled over the next 3 years. Lower interest rates often coincide with economic uncertainty, which also boosts the appeal of gold as a safe haven asset. When you're worried about the stock market's volatility or the stability of your currency, you might find solace in gold's enduring value. With over 5,000 years of surviving every economic downturn and business cycle, gold has proven its time-tested resilience. Before the autumn of 2022, the rise in real interest rates and gold prices typically had a negative correlation. This correlation has now been challenged concerning the present economic milieu, more specifically the U.S. national debt. According to macroeconomic expert Luke Roman, as well as others, the U.S. national debt is simply unserviceable. The U.S. fiscal position is beyond the tipping point where the interest on the U.S. national debt alone is $1 trillion and rising. According to Groman, as well as financial expert Lynn Alden, once the U.S. fiscal accounting hit 120% debt to GDP and 7% fiscal GDP deficits, this negative correlation between the real 10-year interest rate and the price of gold essentially broke. In order to bring the debt to GDP ratio back into balance, the U.S. federal government would have to make serious cuts to the federal budget. Unless the government cuts the largest parts of the federal budget, either entitlement programs or military spending by 20 to 25%, the end effect of this ever-expanding debt is inflationary. That being said, the U.S. federal government indicates no intent to cut either expense. Therefore, in the situation of higher rates versus lower rates, both are inflationary, and by extension, both situations are effectively good for the dollar price of gold. With all these variables in consideration, the classic inverse correlation between real rates and gold prices may be decoupled. Therefore, the present economic milieu requires different decision-making. When starting on the path of gold investing, working with a credible and trustworthy precious metals vendor is key. Finding an established gold investment company that understands the many vacillations of the gold markets and the numerous variables affecting its price will save much time, hassle, and financial setbacks. Working with a reputable company with institutional knowledge can assist you with logical price entry points, positioning, and dollar cost averaging so you can maximize your investment capital. Gold IRAs, more specifically, provide additional advantages to merely buying gold from a local dealer. Furthermore, these companies can provide gold investors access to competitive prices, transparency, a sound buyback policy, reliable customer service, and robust security and protection of their precious metals. We have researched, ranked, and reviewed the top gold IRA companies that meet these individual needs. See the links in the video description to access the free guides from each of these gold IRA companies. Also, see the video in the top right to watch our full review of each of these companies. In summary, knowing the relationship between real interest rates and gold prices is key to successful gold investing. But more importantly, understanding that classic correlations do not always apply. Factors like inflation, geopolitical events, market speculation, and the present decoupling of this classic inverse correlation due to the massive amounts of U.S. national debt is important to consider. With this in mind, good luck on your gold investing journey. If you are a serious investor with a minimum of $100K of retirement savings to protect and want to take advantage of the best gold prices, see the link in the video description to attend a free gold investment webinar hosted by Augusta Precious Metals. Thank you for watching.